Welcome to Talk Tickers, your express route to the essential insights from today's critical earnings calls. We're kicking things off with a deep dive into the latest report from Surgery Partners, ticker SPR.
SPR, yeah. Always an interesting one in the ambulatory surgery center space.
Definitely. Are there strategic moves translating into tangible results? Let's find out.
Well, looking at the first quarter of 2025, it seems Surgery Partners is pretty much performing as expected.
Okay.
They reported net revenue of $776 million, and adjusted EBITDA came in at $13.9 million. Both of those were right in line with their own target.
In line, okay. But what's maybe more interesting is how these figures compare year over year, right? Context is key.
Exactly. And compared to Q1 of last year, we do see a clear upward trend.
How much upward?
Adjusted EBITDA grew by nearly 7% compared to the first quarter of 2024.
Okay, decent growth.
And net revenue saw a healthy 8% increase, so solid year-over-year growth.
And a lot of that comes down to how their existing facilities are doing, I imagine. Same facility growth.
Right, that's a big piece. Their same facility revenue increased by over 5%.
Over 5%. And what's under the hood there? Volume, price.
It was really driven by volume this quarter, a strong 6.5% surge in the number of surgical cases performed.
Wow, 6.5% volume growth is significant.
It is, but there's a slight countercurrent, a roughly 1% decline in the average rate per procedure.
Ah, interesting. So more surgeries, but pulling in slightly less on average per surgery. Okay, let's unpack that. What's causing that rate dip?
Well, the primary drivers appear to be twofold, really. Strong growth in lower acuity specialties, think GI procedures, for example.
Okay, higher volume, but lower reimbursement.
Exactly. And also the ramp up of their newer DeNovo facilities. These are the ones they built from scratch.
Right. New centers take time to hit peak rates and efficiency.
Precisely. Plus, they mentioned they're up against a strong performance in the same period last year, which makes for a tougher comparison on the rate side.
Got it. So mix shift, new facilities maturing, and a tough comp. Makes sense. Looking ahead then, what are their expectations for same facility growth for the rest of 2025?
They're still optimistic. Surgery Partners is aiming for the high end of their 4 to 6% target range for the full year.
Okay, sticking with that target.
Yeah, and they anticipate a more balanced contribution from both volume and pricing as the year progresses. So maybe less reliance purely on volume.
Right, a more even split. That paints a positive picture. And what about the overall financial targets for the entire year? Any changes there?
Nope, they reaffirmed their guidance. Revenue for 2025 is still expected in the $3.3 to $3.45 billion range.
Okay.
And their adjusted EBITDA guidance also remains unchanged at $555 to $565 million.
Reaffirming those targets is definitely a signal of stability or at least confidence in their plan.
Yeah, it generally provides a degree of confidence for investors.
All right, now let's really get into the details of how they're achieving this, starting with their organic growth drivers.
Okay, organic growth. On that front, they've seen a pretty significant increase in surgical activity.
Significant.
Over 160,000 surgical cases were performed in Q1 this year. That's a notable jump from 153,000 in Q1 of 2024.
That's a substantial rise, yeah. About 7,000 more cases. Which specialties are driving that?
Well, growth was pretty evident across all their core specialties, but gastroenterology or GI procedures showed particularly strong volume growth.
Ah, okay, but as you mentioned, those tend to have lower reimbursement rates.
Correct. Which ties back perfectly to the slight rate pressure we discussed. So it seems like maybe a strategic trade-off there, boosting overall volume, even if it slightly impacts the average rate.
Interesting dynamic. What about the higher reimbursement areas like orthopedics? How did they do?
Ortho cases also saw positive momentum. They grew over 4% year over year.
Okay, 4%. Solid.
And within orthopedics, total joint replacements, think hips and knees, experienced an impressive 22% increase.
22%? Wow.
Yeah, really strong growth there. And they highlighted that nearly half, 48% of their facilities now perform these total joint procedures.
Okay.
And even more importantly, maybe 80% have the capability to do them. That suggests a strong runway for further growth in this really valuable segment.
It sounds like a very deliberate focus then on expanding those higher acuity orthopedic capabilities. Are they making other investments to fuel this organic growth?
Absolutely. They've strategically invested in 68 surgical robots.
Robotics, right.
These advanced tools, they not only enhance their ability to perform more complex, higher acuity surgeries, but also serve as an attractive factor in recruiting top-tier physicians.
Yeah, surgeons want the latest tech.
Exactly. And speaking of recruitment, they added nearly 150 new physician positions just in the first quarter.
150 new docs. mostly specialists.
Yeah, with a particular emphasis actually on orthopedic specialists.
Yeah.
And interestingly, this new group, this 2025 cohort, is showing a higher initial level of case complexity or acuity compared to the physicians they recruited in 2024.
So they're potentially bringing in more complex, higher revenue cases right off the bat.
That seems to be the implication, yeah. An increasing focus on complexity.
New facilities are also a key part of their growth equation, aren't they? That DeNovo strategy seems pretty significant for them.
Indeed it is. Since 2022, they've opened 20 DeNovo facilities. 8 of those just opened last year, in 2024.
Okay, that's a rapid build-out.
And they currently have 10 more under construction. So it signals a pretty robust future pipeline.
And these aren't just any facilities, right? They're targeted.
Correct. These new facilities are strategically weighted towards higher acuity specialties like orthopedics. And importantly, they offer a financially attractive entry point, lower multiples, essentially compared to acquiring existing facilities.
Right. So it's a way to expand their footprint in these key high-value areas without paying the higher prices often seen in acquisitions.
Exactly. Lower entry costs, focus on high-value specialties. Sounds like a smart approach.
Okay, let's shift gears a bit to their efforts on margin expansion. You mentioned some slight pressure in Q1.
That's right. The margin pressure in Q1 was primarily attributed to that business mix we talked about. The higher volume of lower reimbursement GI procedures had an impact.
Makes sense. But they expect that to improve.
They do. They anticipate this pressure will ease as the year progresses.
And what gives them the confidence they can achieve overall margin expansion for the full year 2025?
Their confidence seems to be underpinned by several key drivers. First, just continued overall revenue growth.
Okay.
Second, ongoing initiatives to improve procurement, getting better prices on supplies, and just generally reduce cost.
Standard efficiency plays.
Right. Third, operational efficiencies they're implementing across their network. And finally, the increasing realization of synergies, both cost and operational, from acquisitions they've made in the past as those businesses get more integrated.
Leveraging scale and integration. Got it. Now let's talk about their third growth pillar, mergers and acquisitions, M&A. They've certainly been active.
They have, yeah. In the first quarter of 2025 alone, they invested $55 million to acquire 5 surgical facilities.
5 facilities for $55 million. What's notable is the multiple they paid, right?
Exactly. They made these acquisitions at an effective multiple of less than 8 times adjusted EBITDA.
Under 8 times. That's generally seen as quite favorable in this space. Discipline on valuation.
It suggests that, yes.
Yeah.
And looking ahead, their outlook for future M&A activity this year.
They report a strong pipeline of potential partnership opportunities, which they say supports their financial guidance for 2025.
So more deals likely coming. And can they afford it?
Importantly, yes. They emphasize they have sufficient cash on hand and available credit liquidity to fund both near-term and long-term M&A growth ambitions. They don't expect to need to tap the capital markets. That robust liquidity definitely provides flexibility. Good position to be in. They also mentioned something about transaction costs.
Yes, transaction and integration costs were higher in Q1 compared to usual.
Why was that?
It's primarily a hangover from the volume of acquisitions they completed back in 2024 that are still being integrated.
Okay, just working through the backlog.
Pretty much. But they do anticipate a significant decrease in these costs in the second half of 2025 as the bulk of that integration work gets completed.
All right, that covers the internal levers. Let's move to external factors. How is Surgery Partners navigating the current regulatory environment? Any concerns there?
On the regulatory front, they indicated they foresee minimal material impact from tariff-related price increases or supply chain disruptions in the near to medium term.
And why are they so confident about that?
They credit their relationship with Health Trust, which is a large group purchasing organization, or GPO, that gives them pricing transparency. And they also credit the efforts of their own dedicated supply chain team.
Proactive management. Good to hear. What about potential changes in government reimbursement programs, like Medicaid or the ACA exchanges?
Well, they reported that less than 5% of their total revenue comes from Medicaid and those exchange-based insurance programs.
Very small exposure.
Very small. And they also stated they don't currently see any prospective changes in these areas as posing a significant risk to their short or long-term growth. So that limited exposure kind of insulates them.
Okay. Of course, we can't really ignore the elephant in the room, the non-binding acquisition proposal from Bain Capital.
Yeah.
What did they say on the call about that?
Right. They acknowledged they received the proposal back in late January.
Okay.
They reiterated that a special committee of independent directors has been formed, and they're working with independent advisors to review it. Standard procedure.
But beyond that,
Beyond that, they stated very clearly, no further comments on this matter unless there is a material update to report. So for now, it's just a situation under review. No new details.
understood. Keeping close to the vest. All right, let's switch focus back to the financials and some of the key figures they shared. Cash position, liquidity.
Yeah, they ended the first quarter with a healthy $229 million in cash on hand. And their total liquidity, which includes what they can borrow under their credit line, stands at over $615 million. So plenty of flexibility there.
And cash flow from operations.
Operating cash flow was $6 million in Q1 2025. They did point out, though, that this is typically lower in the first quarter.
Seasonality.
Yeah, partly due to the timing of earnings patterns, but also some specific working capital fluctuations this quarter.
Like what?
Well, they mentioned they processed accounts payable more quickly in Q1, which, naturally uses cash in that period.
Okay.
And distributions to their physician partners were also higher in Q1. They said that was due to facility level timing and also the strong performance they had in the prior quarter, Q4 2024.
Oh, okay. Catch-up payments, essentially. On a positive note for cash management, though, what about collecting payments?
DSO. Good news there. Their days sales outstanding, or DSO, actually decreased by 2 days compared to Q4.
Lower is better.
Exactly. It indicates improved cash conversion, collecting money faster.
Okay. What's the latest on their debt situation? How much do they owe?
They currently have $2.2 billion in outstanding corporate debt.
Okay. Any near-term worries there? Maturities?
Importantly, no significant debt maturities until 2030, so quite a long runway.
That's good. And the cost of that debt?
Their effective interest rate was fixed at approximately 6% through the end of March. They also have a $1.4 billion term loan, and that now has interest rate caps in place.
Ooh, limiting the upside risk on rates.
Exactly. It limits the variable interest rate to a maximum of 5%. The current floating rate is actually lower, about 4.3%.
Okay, so the cap isn't biting yet, but it's there as protection.
Right. However, they did flag one thing, the expiration of a previous lower interest rate swap arrangement. That will create a bit of a cash flow headwind for the rest of the year because interest expenses will be slightly higher than they were under the old swap.
Ah, okay, bit of an offset there. And what about leverage ratios? Debt relative to earnings. Investors always watch those closely.
Right. Their total net debt to EBITDA, using the definition under their credit agreement, was reported at 4.1 times.
4.1 times? And is there another way they measure it?
Yeah, using a slightly broader measure of just balance sheet debt to EBITDA, the leverage was 4.8 times.
Okay, 4.1 and 4.8 times. And the expectation is?
They expect both of those ratios to decrease over the course of the year as their earnings continue to grow. Deleveraging is a focus.
Got it. Finally, let's touch on some key takeaways from the Q&A session with analysts. Always insightful. What were analysts digging into?
Yeah, good stuff in the Q&A. Analysts were particularly interested in that strong volume growth, digging more into the reasons for their rate pressure.
The volume versus rate dynamic again.
Exactly. And also the typical seasonal patterns of their free cash flow. The company basically reiterated that the Q1 rate pressure was mainly mix and the tough comp, and they expect that better balance between volume and rate for the full year.
And cash flow seasonality.
They confirmed, free cash flow typically strengthens as the year progresses. Q4 is usually the strongest. And those higher physician distributions in Q1 were largely timing related, not a new run rate.
Okay. Were there any concerns raised about, say, their relationships with insurance payers or cost pressures?
Good question. They indicated they didn't see any significant pressure on payer mix or commercial rates. Relationships with Medicare Advantage plans remain strong, they said.
What about denials? Getting claims paid?
Actually, they noted improvements in denial patterns in Q1, which they attributed to standardization efforts they've been making. So positive movement there.
Interesting. What about costs, like professional fees or anesthesia?
The increase in professional fees was mainly linked to recent acquisitions that came with associated physician practices, so sort of expected. And they explicitly said anesthesia cost pressures are not currently a major headwind for them.
Good to know. It sounds like their efforts to recruit new physicians are also paying off.
Yes, definitely. Remember that 2025 cohort? They're showing higher initial revenue per doctor compared to the 2024 class.
Suggesting they're attracting higher producing specialists or maybe getting them ramped up faster?
Could be either. Or both. They also pointed out that the growth in GI case volume, while strong, is actually running a bit higher right now than their long-term average expectations or algorithm.
So maybe that strong GI growth moderates a bit going forward.
Potentially, yeah.
And their confidence on navigating tariffs. Still strong.
Absolutely. They kept pointing back to their health trust contracts and the visibility they have into their supply chain. Oh, and that higher payout to non-controlling interests, the NCI payout in Q1, they clarified that was just specific timing of distributions at the facility level again.
Okay, timing issues seem to be a recurring theme in Q1. What about future M&A plans and deleveraging targets?
Their target for M&A spend remains around $200 million annually.
Still aiming for that sub-8 times multiple.
Roughly 8 times historical earnings, yeah. And they expect to fund these deals primarily through internal cash flow.
No need for outside capital. And the debt reduction goal.
The stated goal is to get that credit agreement leverage ratio below 3 times EBITDA by the end of 2025.
Sub 3x by year end. Ambitious, but achievable if earnings grow.
And they want to continue deleveraging beyond that. They also clarified how acquisitions fit into same facility growth calcs. Basically, the facility has to be in the portfolio for the entire comparison period, start and end.
Got it. Any other quick hits from the Q&A? Weather. Free cash flow outlook.
Weather had a negligible impact in Q1. They expect free cash flow to grow with the business, even with those headwinds from interest expense and transaction fees.
And the drivers of margin expansion they mentioned? Any more detail?
Yeah, they highlighted rev cycle standardization. That's a multi-year effort, but showing early positive results. Supply chain efficiencies, getting better pricing, and scheduling optimization, just running the facilities more smoothly.
Okay. Flu impact.
Nope, no significant impact from flu on volumes or case mix.
Acquisitions and DeNovos. Any updates there?
They completed 5 consolidating ASC acquisitions year to date. The target is still to have 10 DeNovos under development each year, with several expected to open in both 2025 and 2026.
And those DeNovos, they sometimes start differently, right?
Yeah, interestingly, they often start as unconsolidated minority investments. This can give them access to higher acuity cases and maybe unique pair relationships from the start.
Interesting structure. What about selling off facilities? Any portfolio cleanup planned?
They said the big portfolio refresh they did last year through divestitures isn't expected to be as significant in 2025, but, ongoing portfolio management will continue.
Makes sense. And lastly, cardio. Still a long-term play.
Yeah, cardiovascular procedures are still seen as a longer-term growth area. Regulatory factors kind of influence the pace, but they are making progress, adding cardiac rhythm management, CRM, electrophysiology, EP, and they opened their first cardiac cath lab in an ASC.
A cath lab in an ASC, that's significant.
It is, and the long-term potential is huge, they believe, because of the potential cost savings compared to doing those procedures in a traditional hospital.
All right, a really comprehensive overview of the Surgery Partners Q1 earnings call. Now, for our This Is Not Financial Advice segment, where we think a little outside the box.
Uh-oh.
Okay, considering Surgery Partners' aggressive push into higher acuity ortho, their robotics investments, the whole outpatient shift. Here's a, let's say, creative idea for you.
Lay it on me.
Given the increasing complexity of outpatient surgeries, there's maybe a higher, albeit small, chance of unexpected complications needing rapid specialized transport. Right.
Okay, I see where this might be going.
So consider this. A long position in a regional air ambulance service, specifically one that contracts heavily with ASC networks, particularly in states where the reimbursement for air medical transport is, let's say, favorable.
The secondary effect play.
Exactly. The thesis is, as more complex stuff moves outpatient, the niche demand for rapid, specialized emergency transport from those centers might just pick up. Creates a potential subtle tailwind for these air ambulance providers.
Highly speculative, of course.
Oh, absolutely. Purely speculative, requires massive amounts of due diligence. This is absolutely not financial advice, just a thought experiment based on the trends.
Understood. Well, that wraps up our in-depth analysis of the Surgery Partners Q1 2025 earnings call. We've dissected the key financials, explored the performance drivers, and looked at their strategic outlook.
Yeah, lots to chew on there.
What key insights resonated most with you listening? And what further questions does this analysis spark for your own research?
Definitely things to consider. Join us next time on Talk Tickers as we dive into another crucial earnings report, bringing you the distilled intelligence you need to stay ahead of the curve.